When a corporation buys a competitor for $10 billion, the final price is a highly engineered figure, debated down to the final cent. A company consists of historical performance metrics and future promises. The challenge lies in systematically converting those sprawling, shifting variables into a single, defensible dollar amount. To deconstruct a business from the bottom up, analysts rely on a specific playbook known as the analyst trifecta. This requires mastering 3 disciplines: fundamental accounting, valuation techniques, and strict financial modeling. The process is highly fragile. A single structural error can invalidate the entire analysis. For example, if an analyst accidentally discounts a levered cash flow using the overall weighted average cost of capital instead of the specific cost of equity, the mismatch ensures every resulting number is wrong. Valuation requires extreme precision. Without a rigorous, mathematically sound framework, an analyst produces a spreadsheet that relies more on luck than logic. The life cycle of any deal begins by dissecting the target company's operating reality through fundamental accounting analysis. This diagram maps the core drivers to forecast future cash flow. We isolate historical sales growth, EBITDA margins, and working capital. But M&A distorts these standard reports. Massive transaction costs must be expensed immediately, dropping into the income statement in the exact same period. Bankers modeling the transaction have to proactively adjust for these immediate hits to group profits and lower goodwill. Failing to account for these upfront expenses will lead to significantly overvaluing the target. Historical accounting data in an M&A context is only useful once it is reconstructed to reflect the immediate financial shocks of the deal itself. Once the historical data is corrected, we project future value using the discounted cash flow, or DCF, framework. Specifically, we calculate the free cash flow to the firm, the actual cash generated after taxes and investments are paid. This timeline illustrates the 2 distinct phases of a DCF projection. First is the visible cash flow period, a detailed year-by-year forecast. Below that sits the terminal value, a solid block representing the firm's worth as a perpetuity long after that initial period ends. Because future cash is never guaranteed, it is subjected to a heavy discount rate to account for market risk. This graphic breaks down the capital asset pricing model, or CAPM. This is the industry standard formula used to calculate the specific equity cost of capital, mapping exactly what return investors demand as a reward for taking on market risk. While CAPM is the dominant tool used by most banks, analysts must be prepared to defend their choice of model. They may need to justify it against alternative risk frameworks, like arbitrage pricing theory or multi-factor models. A DCF is the gold standard for finding intrinsic value. Yet despite all the complex math, it remains a theoretical projection, built entirely upon a fragile foundation of assumptions. To test those assumptions, we pull the math out of theory and subject it to market reality. We do this through relative value. This involves measuring a company against comps, comparable publicly listed companies, and analyzing historical precedent transactions to see what buyers actually pay. Here is how a comparative analysis works in practice. We use firm value multiples, specifically dividing enterprise value by EBITDA. This metric allows us to benchmark the target company and see exactly how its valuation aligns against its peers in the same industry. Analysts use this hard comparative data to actively check their DCF exit assumptions. If the open market is paying 8 times earnings and your model predicts 15, your terminal value calculations are likely overestimating growth. The right price of a company is triangulated precisely in the crossfire between mathematical theory and what the open market is actually willing to pay. The final phase of the deal life cycle is mechanical execution. All of this extracted data, the projections, and the market comparisons must be embedded into a single, cohesive Excel architecture. The foundational hygiene rule of an investment banking model is structural isolation. All inputs and core drivers must be contained in a single, distinct location. A scattered assumption can trigger cascading errors throughout the entire worksheet. With the structure built, rigorous stress testing begins. Does the present value of the visible cash flow cover current net debt? Are WACC and terminal growth rates justifiable? Ultimately, the model must flawlessly generate a balancing balance sheet, where total assets perfectly equal liabilities plus equity. A successful deal analysis relies on a meticulously constructed and audited system. When every module is tied to a balancing balance sheet, the spreadsheet provides a defensible representation of the acquisition's financial impact.